Last week, we learned that Warren Buffett and Berkshire Hathaway invested a few $1 billion into HP stock. On the heels of this news, in this video, I'm going to do an intrinsic value analysis on HP using a discounted cash flow model. As always, this video should not be taken as specific financial advice for your own situation because everyone's situation is different. Yours might be very different than my own. So if you need specific advice for your portfolio, be sure to consult with a licensed financial professional because I am not one of those. Anyways, let's get into it. Here's the big recent news about Warren Buffett and Berkshire Hathaway buying into HP, approximately $4.2 billion based on a share price of around $35 to $36 per share for 121 million shares in the business. It's a little bit over 10% of the company, if I'm not mistaken. So it's definitely a significant bet on the company, though do realize that it's pretty small in the grand scheme of Berkshire's portfolio, but hey, it's a starting point, so let's see if there's something here. Here's HP's stock price, and this is specifically HPQ, separate from HPE, which was a spin-off from this stock right here, HP Incorporated, HPQ, the stock ticker. So I'll get back to that in just a second, but they're currently sitting at about $38.63 per share, which puts them at a market cap of around $40 billion, just under $41 billion. And the stock has done pretty well over the last year, up nearly 20%, and you had a bit of a spike on the news, although if we go to the year-to-date view, it's pretty flat on the year, up a couple percent, so it's something, but a lot of it coming from that recent news that Warren Buffett actually bought into the stock. Otherwise, it would actually be down on the year-to-date chart. Let's go on down to the description. HP Incorporated provides personal computing and other access devices, imaging and printing products, and related technology solutions and services in the US and internationally. The company operates through three segments: personal systems, printing, and corporate investments. The personal systems segment offers commercial and consumer desktop and notebook personal computers, workstations, thin clients, commercial mobility devices, retail point-of-sale systems, displays, and other related accessories, software support, and services. It's a bit of a mouthful. The printing segment provides consumer and commercial printer hardware, supplies, solutions, and services, as well as scanning devices. The corporate investments segment includes HP Labs and business incubation projects. So in general, it is a hardware business, and specifically for printers, and we'll call it personal computers, and really with sort of an office focus. And that's for individuals and businesses alike. And one thing I didn't realize is that HP was actually founded all the way back in 1939. So obviously a very different business now than it was back then, but it's been around for quite some time. Let's go ahead and take a look under the hood. I usually like to start with the balance sheet, so we'll start there. Let's see how much cash they're working with. Currently have around, we'll call it $3.5 billion in cash. And I like to compare that to their debt, specifically their long-term debt. So if we go down to liabilities, we can see long-term debt is a bit higher than their cash at about $6.4 billion, at least in the last 12 months sort of measurement here. They also have a bit under $1 billion in capitalized leases here, so that's something to note. So we'll call it about $7.3 billion or so in long-term debt if you combine those two together, compared to their about $3.4 billion in cash and short-term investments. So significantly more long-term debt, at least compared to their current cash pile. But one more thing I like to look at on their balance sheet would be their total shares outstanding. Are we seeing a lot of dilution or share issuance, or are we seeing buybacks? And we are seeing a ton of buybacks. This is just over the past 5 years. We've seen almost half of the shares, about 700 million shares out of the former 1.7 billion. So a huge portion of the shares have been bought back. And we can take a look at this graphically as well. And we can see that they have really been chipping away at their share count. And what this means is that now every existing shareholder now has a bigger fraction of the underlying business without anything else changing. And in that way, share buybacks are a way for companies to return capital to shareholders. Sometimes they do this with dividends. Sometimes they simply reinvest back into the business and grow the equity that way. But another way is through something like share buybacks, where they're actually actively buying back their shares. So now there are less outstanding shares out there, yet you still have your shares, but they now make up a greater portion of the overarching business. This is the opposite of dilution, where a company is actually issuing new shares so that every single outstanding share is worth less than before because there are simply more of them out there, sort of like inflation, but for stock shares. It's clearly been a big part of HP's capital allocation process over the last few years, especially. So that's something to note. And because this is a more hardware focused business, I do want to take a quick look at inventory here. So if we go on up to assets again, you can see that they have around $9 billion in inventory. And I suppose you could look at this like a sort of worse version of cash, in that if they really needed to liquidate this, they could sell things at fire sale prices, but then you'd be losing the value here on the balance sheet. But it is something to note that this isn't like dead weight or something like that. It's inventory that they can sell. It has value. And it looks like their inventory is a bit higher than it has been in recent years, so that's something to note. That's it for the balance sheet. Let's take a look at their income statement to see what kind of money they're bringing in on the top line. So this is their revenues, and we can see that revenues have been growing kind of sporadically. If we take a look at the last few years, we've seen some years where they've had some pretty significant growth, then they've been flat. They actually went down a bit between 2019 into 2020, but then they've shot back up in 2021. But overall, a general sort of gentle trend upwards, at least in the last 5 years. And this doesn't actually show the last 12 months, but you've seen still a slight progression upwards compared to the previous 12 months. Meanwhile, their margins have been very stable around that 18 to 20% range for the last few years, which is good to see that you're not seeing huge compression. In fact, you're seeing some expansion in gross margins, up over 20% recently. Because we did take a look at the debt on the balance sheet, let's see how that's affecting their income statement. We can actually go down here and see what kind of interest costs they're facing. Right now, it looks like only about $250 million per year, which is peanuts compared to the $65 billion or so in annual revenue over the last 12 months. And just doing some very rough math, $250 million on about the $6 to $7 billion in debt would put them at around a 4% average interest rate on the debt, annualized interest rate that is. Now, I'm not sure what the exact debt terms are here. I would want to take a little bit of a closer look there, but overall, it doesn't seem like it's that huge compared to what they're bringing in. And it does seem to be at a pretty good rate. Hey guys, real quick, be sure to check out M1 Finance if you haven't already. It's a free-to-use stock brokerage that I've used for quite some time now. I actually have a whole series dedicated to my M1 Finance portfolio, which you can check out in the description below. But I always have an affiliate link also in the description if you want to check it out for yourself. It's easy to use and has a great user interface. And if you use my link below, that could go a long way towards helping my channel if you end up funding your account. But anyways, let's get back to it. Let's go ahead and take a look at my favorite part, and that is the cash flow statement. After all, anyone can blow out the spending to simultaneously increase their top line revenue, so it doesn't tell the whole story. You want to take a look at the whole picture, and one of the last things I like to focus on is the free cash flow that business is throwing off. And free cash flow is done by taking cash from operations minus capital expenditures, and this is sort of like your take-home number for the business. This is money that the business can use to reinvest back into itself. You can use this money to pay back shareholders via dividends or share buybacks. So this is a very important number for pretty much any business. And HP, as we can see by this graph here, has been generating consistent and pretty substantial free cash flows. And during the period from 2020 into 2021, they had about $5.9 billion in free cash flow. Let's go on down to the trailing 12 months to get a more recent number. They're up over $6 billion in free cash flow at about the $7 billion minus the $724 million in capital expenditures would put them at around 6.3, we'll call it, in free cash flow. And that is quite a bit higher than where it's been. If we go on back up to this graph, it seems to have been hovering around more that $4 billion number, at least for a few years, and it really has spiked pretty recently. So is this temporary? That is a big question, but either way, they've had pretty consistent and significant cash flows that continue to trend upwards, at least generally speaking, over the last few years. But now the question becomes, what's going to happen with these cash flows? Are they going to go up, go down, stay sideways? You can make money in any of those situations if you get something for the right price. But either way, that's really what investing comes down to. What are the future cash flows for this thing that I am buying? And you sort of backtrack from that to come up with some sort of value. At least that's how many value investors would look at it. To try and get a slightly better idea of what's going to happen in the future for HP. Obviously, no one actually knows this for certain. We're trying to tell the future here, but let's see if we can get somewhat of an idea of what's going on. So here is a graph showing the revenue breakdown for HP. And you notice how there are many more categories than there currently are, at least prior to 2016. And this is where that HPE, and HPE stands for Hewlett Packard Enterprises, if I'm not mistaken. They spun off a lot of the non-sort of hardware stuff into HPE, and that is now a separately traded stock. And I don't believe HPQ, this stock we're looking at, actually owns a significant stake in HPE anymore. I think they probably own something, but I think the majority of HPE is owned by institutional investors last I checked. But in any event, that's why you're seeing this sort of shift in 2016 to only include the personal systems and printing breakdowns in revenue. And you can see that personal systems, which would include laptops, hardware, that sort of stuff, is a much bigger segment of their overall revenues compared to printing. Printing being printers and printing supplies. That is around $20 billion as of 2021 versus versus the 43 or so for personal systems, laptops, and all that. And it does seem like the main growth engine here has been personal systems. For the growth they've had, it has come from that. Printing has remained relatively stable, which I guess makes sense. Once you buy a printer, you're going to buy the supplies, and you're not really looking to buy a printer every single year, though I guess you could say the same about a laptop. If you buy a laptop in 2016, you're probably not going to need one for a few years, as long as it's built well, of course, which would lead me to believe that this 2020 into 2021 spike here in personal systems revenue might be COVID driven. You have people working from home. Maybe they need to upgrade their computer. Maybe businesses are buying laptops for their employees to take them home with them. So you could easily make an argument that this is a very temporary spike compared to their sort of historic trend. And interestingly enough, if we go all the way back to 2010, we can see that the personal systems segment was about $40 billion, which is pretty similar to where it is today. So how much growth are we really going to expect from here, just looking at this sort of historic trend? It's been pretty flat over this pretty broad period. So I'm definitely going to be hesitant before I try and make lofty growth projections for HP. And if we go ahead and take a look at their annual report for 2021, this was released back in November, so a few months ago now, but still kind of shows you the general trend. If we go ahead and scroll down here to some of their sort of summary of where the growth was in the year, they note that personal systems net revenue was up about 13% year over year, while printing was up only 1% year over year. So again, going to that overarching theme that the growth is coming from personal systems rather than printing. But note that consumer PCs net revenue decreased about 3% over the year, while commercial PCs net revenue increased 25%. So that would go maybe to that theme of businesses buying computers for their employees to work remotely, or maybe refitting some office or somehow allowing for more remote work, I would imagine, is where you'd have this sort of major increase in this revenue, which I do think would go to support the thesis that this was more of a temporary spike rather than a long-term trend, though again, time will tell. So let's go ahead and plug some of these numbers into this discounted cash flow model to try and get an intrinsic value for HP. This is, again, trying to tell the future, so don't take this as hard fact or science. We are ultimately guessing here as to what's going to happen for HP. So do your own research, make your own assumptions. But here's the assumptions that I'm using. We have our year zero cash flow of $6.3 billion. This is our starting point. We're going to grow those cash flows at 1% per year for the next 10 years. This is a 10-year analysis. At the end of 10 years, we're going to assign a terminal multiple of 15 to whatever that ending free cash flow number is, and that gets us the terminal value of the business, so 15 times their year 10 free cash flow. Then we have the excess capital number, which in this case would be negative because it takes your cash minus your long-term debt. So that ends up being about -$3.9 billion. So we take our year zero free cash flow, grow it by our applicable growth rate of 1% in this case for those 10 years, multiply the year 10 free cash flow by the terminal value to get us this terminal value of the business. We then use our discount rate to discount all of those cash flows, and we total all of those up together to get a present value of future cash flows of about $58.84 billion. And if we subtract the excess capital number, or in this case, we'd add the negative, that would get us to almost $55 billion as our intrinsic value for HP. And if we compare that to the current market cap, actually, this is a little bit high. It's more like $40.69 billion in market cap. So that would imply that we have a margin of safety of 35% if we are to believe all of these assumptions. And this is where I'd like to pump the brakes a bit, because we're assuming this year zero free cash flow of $6.3 billion, so that they can maintain this and grow it very slightly at 1% per year on average for the next 10 years. Personally, I'd rather bump this down a bit and assume that those cash flows are going to come down a bit. So maybe back down even to, I don't know, $5.5 billion. So still a bit higher than historically speaking, at least over the last few years, but it's lower than where they're currently at. We'll see some sort of regression back to the norm, perhaps. In that case, it still looks pretty good. You still have about a 17% margin of safety, assuming a 1% growth rate per year. And maybe you want to bump this down even further, maybe to about $5 billion. Still, you have a little bit of a margin of safety there at 5%, and it still looks like a pretty decent deal if you think their sort of bottom level cash flow would be $5 billion. Or perhaps a more accurate way to do this would bring us back up to the $6.3 billion. Say they maintain that for this next year, but they actually sort of shrink over the next 5 years. We'll say, I don't know, 5% per year for the next 5 years, followed by 2% growth after that. So at the end of year one, you'd shrink to under $6 billion in cash flow, actually under $5 billion within a few years, but then you climb back over $5 billion, but still lower than actually where you were at year one at the end of 10 years. And in that case, we still have a margin of safety here, albeit a very slight one, but you can play with these numbers however you want. You can make different assumptions. Maybe you think HP is going to shrink very significantly over the next few years. Maybe you think it's not going to grow at all. Maybe you want to use a different multiple, that 15 might be a little bit too lofty. Maybe it's back down to, say, a 12 or a 10 multiple for the terminal value. You can play with these numbers and you can sort of manipulate the results in that way based on whatever you think is going to happen. You can see why an investor like Warren Buffett would be interested in a stock like HP, even though it doesn't have lofty growth projections ahead of it. In fact, it might shrink a bit, but even in that case, you could still come out with a pretty decent investment because the cash flows seem to be pretty predictable. Of course, we'll see what happens in the future. Everything's predictable until it isn't. And I'm definitely interested in HP for my own portfolio. The Berkshire position is obviously a nice vote of confidence. I have seen it pop up on the Magic Formula screener a number of times. I think it's currently on there right now. So it looks cheap by many different metrics. And I'd want to get a slightly better understanding of where that growth for 2020 into 2021 really came from. Is that going to maintain itself for 2022 and beyond? I'd want to figure out a little bit more about what's going on there before I was to take a big swing. But overall, I'm definitely interested in the stock, so I might be doing something with this in the near future once I do some more research. And of course, once we get past tax season, I figure out how much cash I actually have available to begin investing again. I've kind of taken a pause for the last month while I sort of wait to get through tax season. But in any event, this does seem like a pretty decent illustration of how you can make money with a stock or a company underlying a stock that really doesn't do a whole lot. Like, it's not as though we're projecting 20 or 30% growth for HP. It could even shrink a bit from its current levels and still end up in a decent position, again, depending on your assumptions and your own investment criteria. But whatever the case, like I said at the top of the video, be sure to do your own research before you invest in any stock or do any sort of investment, because it is all up to your own risk profile and your own assumptions in the underlying investment. Otherwise, if you like this video, definitely like it, since that would help the channel out a lot, and be sure to check out the affiliate links in the description for some free stuff, and that will go a long way towards helping the channel. And be sure to subscribe so you don't miss future updates. But until next time, take care.